Imagine you wake up tomorrow morning and your bank account is frozen. Not because you did anything wrong, not because the bank collapsed, but because someone, somewhere, decided you shouldn't be allowed to use your own money today. No explanation, no appeal, just a red warning on a screen. For most of modern history, this wasn't a hypothetical. Money has always belonged to someone else first. Kings, states, banks, central authorities. You were just allowed to borrow it. Every financial system humanity built shared one silent assumption. Trust a middleman. Trust the king not to debase the currency. Trust the bank not to gamble your savings. Trust governments not to print money until it's worthless. And every few decades, that trust broke. The Great Depression wiped out lifetimes of savings overnight. Hyperinflation in Weimar Germany turned salaries into firewood. In 1971, the US quietly removed gold backing from the dollar. And the world entered the age of pure fiat money, backed by nothing but belief. By the late 1990s, the internet had connected the planet. But money was still stuck in the past. Emails traveled instantly. Information moved freely. But sending money still required permission. And then came 2008. Banks collapsed. Governments bailed them out. Ordinary people paid the bill. That moment cracked something fundamental. For the first time, millions of people began asking a dangerous question. What if money didn't need trust at all? What if it didn't belong to banks, governments, or anyone? What if money could run on math instead of authority? The idea sounded insane. And that's exactly why it worked. ICT2, the crisis that gave birth to an idea, October 2008. While financial news screamed about collapsing banks and emergency bailouts, a quiet document appeared on an obscure cryptography mailing list. No press conference, no company logo, no author's real name, just 9 pages. The title was unremarkable. Bitcoin, a peer-to-peer electronic cash system. The author called himself Satoshi Nakamoto. To this day, no one knows who that is. But the timing was not an accident. Bitcoin wasn't born from optimism. It was born from rage. Rage at banks that privatized profits and socialized losses. Rage at governments printing trillions to save systems they claimed were too big to fail. Rage at a monetary system that demanded trust and constantly betrayed it. Satoshi's idea was brutally simple. No banks, no central authority, no permission. Instead, a public ledger, the blockchain, where every transaction could be verified by anyone, anywhere. Trust replaced by cryptography. Rules enforced by code, not humans. And embedded in Bitcoin's very first block was a message. Not technical, but political. The Times, March, January 2009. Chancellor on brink of second bailout for banks. Bitcoin wasn't just technology. It was a statement. A monetary system created not to make people rich, but to make money ungovernable. At first, nobody cared. Bitcoin was worth nothing. It had no backing, no legal status, no believers. Just a small group of programmers running software on their computers, trying to answer a question history had never solved. Can money exist without trust? And unknowingly, they had just opened a door that could never be closed. In the beginning, Bitcoin wasn't an investment. It was a curiosity. Early users weren't traders. They were programmers, libertarians, and cryptographers. People more interested in ideas than money. Bitcoin had no price because no one knew what it was worth. Then, in 2010, something strange happened. Someone paid 10,000 Bitcoins for 2 pizzas. At the time, it wasn't a headline. It was just proof that Bitcoin could be exchanged for something real. But that moment quietly answered a critical question. This thing works. Bitcoin began trading for pennies, then dollars, then tens of dollars. And with value came attention. Governments noticed, banks noticed, Criminals noticed. Silk Road used Bitcoin to bypass financial surveillance. Media labeled it drug money. Regulators called it dangerous. Economists laughed. Bitcoin was declared dead. Again, and again, and again. But it didn't disappear. Every time a government restricted it, people routed around the restriction. Every time a bank refused it, peer-to-peer markets replaced the bank. This was new. Previous alternative currencies failed because they needed trust. Bitcoin didn't care if you trusted it. It ran whether you believed in it or not. By surviving its own chaos, hacks, crashes, scandals, Bitcoin proved something bigger than price. A decentralized system could exist without permission. That realization would not stay contained, because Bitcoin solved money. But the technology behind it could do much more. If Bitcoin was a rebellion against banks, the next phase was a rebellion against everything else. In 2015, a young programmer named Vitalik Buterin launched Ethereum. Bitcoin was digital gold, slow, rigid, secure. Ethereum was different. It wasn't just money, it was a platform. Ethereum introduced smart contracts, code that could automatically execute agreements without lawyers, banks, or intermediaries. If this, then that. No trust required. This changed the question. Crypto was no longer just about currency. It was about replacing institutions, finance, insurance, property ownership, even organizations themselves. Startups raised billions through ICOs. Developers promised a future without banks, brokers, or borders. And money flooded in. Speculators arrived. Hype exploded. Scams followed. Prices went vertical, then collapsed. Ethereum survived. Bitcoin survived. And the lesson became impossible to ignore. Crypto wasn't a fad. It was infrastructure. Just like the early internet, it looked chaotic, dangerous, and useless. Until suddenly, it wasn't. But with scale came new enemies. Governments didn't fear crypto because of crime. They feared it because it challenged something far more powerful: monetary control. And the moment crypto became big enough to matter, the fight truly began. For most of its early life, crypto was easy to ignore. Too small, too volatile, too weird. But then something changed. Bitcoin crossed hundreds of billions in market value. Ethereum became the backbone of an entire financial ecosystem. Millions of ordinary people now held assets that did not sit inside banks. And that's when governments stopped laughing. Because money isn't just a medium of exchange, it's power. Whoever controls money controls taxation, inflation, sanctions, and crisis response. Crypto threatened all four. China moved first. Mining bans, exchange crackdowns. Entire regions went dark overnight. Bitcoin's hash power collapsed and then quietly relocated across borders, mostly to the United States. That was the moment governments learned an uncomfortable truth. You can ban crypto locally, but it moves globally. The US took a different approach. Not outright bans, regulation by pressure. Banks were warned. Exchanges were sued. Rules were unclear by design. Innovation slowed, but didn't stop. At the same time, Wall Street entered. Bitcoin ETFs, institutional custody, corporate balance sheets. Crypto was being absorbed by the very system it was meant to escape. And yet, something deeper was happening underneath the headlines. Decentralized finance, DEFI, recreated lending, borrowing, and trading without banks. Stablecoins began settling billions in transactions daily. In some countries, crypto wasn't speculation anymore. It was survival. In places where inflation erased savings, crypto became a lifeline. In places cut off from banking, it became access. This wasn't ideology. It was utility. Governments now faced a dilemma: crush it and push it underground, embrace it and lose monopoly control, There was no clean solution. And then, greed stepped in. Every financial revolution attracts two groups: builders and opportunists. Crypto's bull market turned paper millionaires into influencers. Leverage replaced patience. Risk became invisible. New tokens promised impossible returns. Exchanges acted like banks. Without safeguards, founders were treated like prophets. And then it snapped. Projects collapsed overnight. Stablecoins broke their pegs. Funds evaporated. The fall of major players wiped out hundreds of billions in value. For outsiders, it looked like proof that crypto was a scam. For insiders, it looked familiar. This wasn't a crypto failure. It was a human failure. The same cycles that destroyed banks in 2008 had reappeared, just faster, louder, and without regulation. But here's the part history remembers. After the crash, crypto didn't disappear. Bitcoin kept producing blocks. Ethereum kept processing transactions. Developers kept building. Speculation burned away. Infrastructure remained. Just like the dot-com crash didn't kill the internet, it killed bad companies. What survived was quieter, more serious, less utopian. Crypto was no longer about getting rich overnight. It was about what actually works. And now the final question remains: was this a financial revolution, or just another experiment that proved why money has always been centralized? The answer depends on what happens next. Strip away the hype, the scams, and the price charts, and something important remains. Crypto did not replace banks. It did not overthrow governments. It did not end inflation or create a borderless utopia. But it did change the rules. For the first time in modern history, money became programmable, portable, and permissionless at a global scale. Anyone with an internet connection could hold assets without a bank, transfer value across borders in minutes, and verify ownership without trusting an institution. That had never existed before. Crypto forced central banks to confront competition. It forced regulators to modernize. It forced financial institutions to admit their infrastructure was outdated. Even critics now use blockchain concepts, just under different names. And yet, the limits became clear. Decentralization is powerful, but inefficient. Freedom removes guardrails and attracts abuse. Code eliminates trust, but not human greed. Most people didn't want financial sovereignty. They wanted higher prices. When markets fell, belief vanished. Crypto didn't fail because it was too weak. It struggled because it demanded responsibility in a system built on protection. In the end, crypto didn't replace the old system. It exposed it, and that exposure can't be undone. Every financial revolution goes through the same 3 stages. First, it's dismissed. Then it's ridiculed. Then it's regulated. Crypto has reached stage 3. Today, governments are building digital currencies. Banks are tokenizing assets. Wall Street is integrating blockchains into settlement systems. The irony is complete. The technology born to escape the system is now reshaping it from within. Bitcoin may never become everyday money. Ethereum may never replace institutions. Most tokens will vanish. But the idea survived. That money doesn't have to be issued by trust. That value can move without permission. That financial infrastructure can be redesigned. Crypto wasn't a replacement. It was a stress test. And it revealed just how fragile and outdated the global financial system really is. History won't remember crypto as a price chart. It will remember it as the moment money stopped being just money and became software. The revolution wasn't loud. It was silent, mathematical, and irreversible. And just like every true financial shift before it, we won't understand its full impact until decades later.